Hello, my name's Darlene Felsch. I'm a certified practicing accountant and an accounting tutor. This is part of a video series I've created for Year 11 and 12 students to fast track them through their studies in just 10 weeks. I hope you enjoy the program. Purchase of a house. To further our understanding of the accounting equation and debits and credits, we are now going to introduce one more example from our everyday life: buying a house. Most people understand the concept of buying a house, putting down a deposit of your own money and taking out a mortgage for the balance. Usually when you buy a house, the bank requires that you put down a 10% deposit. Let's say the house costs $500,000. The 10% deposit we have to pay from our own money is $50,000, which is 10% of $500,000. We will therefore take out a mortgage of $450,000, which is the total of $500,000 less the deposit of $50,000. Firstly, how would we record this using debits and credits? The principle is exactly the same as the entries when we bought a car. Here we have the bank account. The first thing we do is pay the deposit from our bank. So we record $50,000 on the credit or the outside of our bank account. The second part is to take out the mortgage on the house. This is recorded as a credit of $450,000 to the mortgage account. The last entry is to the house account. A house is coming in to our possession. So we're showing the purchase of a house on the debit or the inside of the house account for $500,000. How does this look when we combine the accounts together? Number one, paying the deposit out of your bank is $50,000 in the credit or the outside. Number two, taking out a mortgage for the house is $450,000 recorded also on the credit or the outside. Number three, we record the purchase of the house, which is coming in to our possession. So it's on the debit side for $500,000. This is how the debits and the credits to the accounts are shown on the accounting equation. Remember, assets equals liabilities plus owner's equity. You can see in the diagram we have the assets on the left hand side, which is the house for $500,000. Then we have the liability on the right hand side, which is the mortgage of $450,000. On the credit side we also have owner's equity, which is the deposit we paid from our own money of $50,000. From the example of the purchase of a car and the purchase of a house, we see the following. Assets are something that you own or are paying off. Liabilities are something that you owe to others. And owner's equity is how much the owner personally contributes. Or it could also be how much is left over when you calculate total assets less total liabilities. Total assets less total liabilities equals total owner's equity. Another way of understanding the accounting equation is that assets are what the business owns or is paying off. Liabilities and owner's equity represent a claim on those assets. Liabilities represent a claim on the assets by external parties, such as suppliers and banks or lending institutions. Owner's equity represents the claim on the assets by the owners. That's the end of the lesson for today. I hope that you've enjoyed the lesson. We'll see you next time. Bye.